Quick reminder, nothing we say is financial advice. We're two guys on a Saturday morning arguing about whether the market bothered to read the news this week. Do your own research.
What's up, trading bros and sisters? Welcome to the Trading Floor Weekend Edition. Week 21 is in the books, and I genuinely do not know whether to be impressed or confused. The tape went up, the data went sideways, and somehow those two things coexisted for 5 straight trading days without the market flinching once. I'm Wildcard. That's TV. It's Saturday morning, the coffee is hot, and we have got a full show for you. Let's run it. Let me give you the scorecard first, because the numbers are what make this week so strange. The SPY finished up 0.79%. The QUES up 0.84%. The Dow, which you can track through the Dow, up 2.1%. And small caps, the IME, led everything at plus 2.29%. The Fear Index, the VIX, dropped 13%, from 19 down to 16.7. Green across the board. By Friday, you'd look at that tape and think everything was fine. And let me flip it. Consumer sentiment this week came in at a record low. Not just bad, an all-time record low. The Philly Fed Manufacturing Index printed at negative 4.0. The estimate was positive, 17.8. Homebuilder, Hovnanian, swung from a profit to a loss. Mortgage rates are above 6.5%. And the market went up, the same week that data hit the tape.
The market and the economy are not reading from the same page right now. Either the market is pricing something the current data doesn't reflect yet. It's forward-looking, anticipating improvement. Or the market is wrong and the data is going to force a correction. Those are the two possibilities.
Which one is the market and which one is the economy? Because right now they're having two completely different conversations. That's the question every segment today is going to answer. And here's the honest truth. We don't know yet. But by the time we get through the chip rotation, the oil trade, and what Kevin Warsh just walked into, I think it's going to get clearer. Let's go. Whoa! NVDA, ticker NVDA. Jensen Huang walked into earnings this week and put up $81.62 billion in revenue. Beat earnings per share by 10 cents. Guided above consensus for next quarter. Dropped an $80 billion share buyback on the table. By any measure, that is a perfect quarter. And the stock fell 6.3% on the week.
The market had priced a perfect quarter months in advance. When perfect actually arrived, there was nothing new to buy. The trade was finished, so capital moved.
It moved directly to Advanced Micro Devices, ticker AMD. AMD ran 8.85% on the week. No earnings. No product launch. No major announcement. Just 8.5 points on pure rotation.
WaveTrader caught the same signal through Qualcomm, ticker QCOM. All 3 conviction tiers fired. That's the system flagging high confidence. Same rotation thesis, different entry point.
My TFT system flagged AMD early in the week. Entered at $441, sitting at $467 by Friday. But here's what I really want to talk about. Because the wrong read is NVIDIA is done. That is not what happened.
ARM Holdings, ticker ARM, up 15% on the week. No earnings, no news, no product launch. 15%.
So we've got AMD up almost 9%, ARM up 15%. On the same week, NVIDIA got sold off after a perfect quarter. That is not the market saying artificial intelligence hardware is over. That is the market saying the artificial intelligence hardware trade is maturing. It's widening.
Jensen Huang talked about physical artificial intelligence at earnings. Robotics, autonomous vehicles, the next layer of the build-out. That vision is real. But it's a 2028 story. The market wanted revenue that exists today, this quarter. When NVIDIA delivered great but not new revenue, money moved to AMD's custom chip push, and ARM's intellectual property licensing into everything from phones to data centers. Both of those names have cleaner near-term upside on the thesis.
ARM licenses their architecture into basically everything. Every new server chip, every new mobile processor, there's ARM intellectual property underneath it somewhere. 15% on no news makes sense once you see the rotation picture. The artificial intelligence trade didn't die on NVIDIA's earnings. It found fresh legs, and those legs ran.
The distinction matters going into next week. This isn't a sector call-off. It's a diversification. One name carrying the entire artificial intelligence hardware trade was always going to be temporary.
Oil, 5 days. From $106 a barrel all the way down to $96.60. That is just under a 9% drop in 5 trading sessions. And the reason is one of the stranger things I watched happen in a market this week.
Rubio called the Iran talks promising. That was the catalyst. The market heard one optimistic headline and immediately sold every barrel of geopolitical fear premium it had been holding.
No deal. Nothing signed. No framework on the table. The Strait of Hormuz tolls are unresolved. The enriched uranium questions are unresolved. Rubio said, good signs, and oil dropped 9% on that.
Here's the data that tells you the market overreacted. Gold dropped 0.92% on the week, less than 1%.
Walk me through why that matters.
Gold prices long-term geopolitical risk. When real de-escalation happens. When the underlying risk genuinely decreases. Gold follows. If the Iran talks were actually producing results, if the Strait of Hormuz were genuinely more secure, gold drops alongside oil. It dropped less than 1%. Gold doesn't believe the deal is real.
What about the bond market?
The 30-year Treasury yield is at 5.13%, flat on the week. If markets were genuinely pricing a calmer world, long-duration bonds move. Perceived risk falls, yields fall, prices rise. Nothing moved. Two instruments that exist to price long-term risk both looked at the oil move and disagreed. Oil was reacting to a headline. Gold and the 30-year were not.
So the VIX drops to 16.7, oil crashes 9%, the indices go green. And meanwhile, gold barely moved, and the 30-year held flat. Those two facts can't both be right.
VIX is right about 2 weeks. Consumer sentiment is right about 6 months.
Say that again.
The VIX measures short-term volatility expectations. If it's pricing lower fear, it might be right that the next 2 weeks feel calmer. Maybe the Iran headlines do cool off temporarily. Consumer sentiment reflects where people actually are right now, their confidence, their plans. And consumer sentiment just hit a record low. Both things can be partially true at the same time, but only one of them tells you where the economy is going over the next 2 quarters.
This rally was built on a press conference, not a deal. And the risk going into next week is straightforward. If Iran talks collapse, if Rubio gets off a plane and says negotiations are over, oil goes right back to $106 overnight. Everyone who sold fear premium on that headline has to buy it back fast. That's what's on the table Monday morning. Kevin Warsh, new Federal Reserve Chair, nominated by President Trump specifically to cut rates. And the Wall Street Journal ran a headline this week. I am quoting it directly. Trump picked Warsh to cut rates. Markets are bracing for the opposite. That sentence is the entire story.
Warsh has a documented record. He dissented against quantitative easing under Ben Bernanke. When the rest of the Federal Reserve Committee wanted loose monetary policy, Warsh voted against it. That's not slightly hawkish. That's a hawk who is willing to stand alone against the consensus on the most important committee in global finance.
And his day one inbox? Moody's downgraded the United States debt outlook. Yardeni, major institutional economist, calling for a July rate hike. Bank of America flagging stagflation risk. That is the desk he walks into on his first day.
The IME ran 2.29% this week, the best performing major index. That rally is priced on rate cut expectations. They carry more floating rate debt than any other asset class. When rates fall, they benefit the most. When rates hold or rise, they get hit hardest. If Warsh signals he's not cutting, that rally just got the biggest head fake of the year.
And nobody is talking about this. NVIDIA earnings were everywhere. Oil crash was everywhere. Warsh's nomination got buried under the noise. But he's the one person who can walk up to a podium in 3 weeks and blow up the small cap rally with one sentence.
The June Federal Open Market Committee meeting is 3 weeks away. That's his first real moment. Does he come out signaling cuts, or does he correct what the market thinks it knows about him?
3 weeks. If you're in small caps right now, you are in a rate cut trade. Make sure you know that's the actual bet you're making.
Earnings next week. Wednesday, Salesforce, ticker CRM, Marvel Technology, ticker MRVL, Synopsys, ticker SNPS, and Snowflake, ticker SNOW. Thursday, Dell Technologies and Costco.
Which one's the tell?
Marvel. They design custom chips for hyperscalers, the biggest cloud companies. No China exposure, which means this is pure United States artificial intelligence infrastructure demand. After watching NVIDIA fall 6% on a perfect quarter, Marvel's print Wednesday night is the next vote on whether artificial intelligence capital spending is still accelerating or starting to plateau. If Marvel beats and holds, the rotation thesis gets confirmed. The big players are still building. If Marvel misses, you have to ask harder questions about the whole build-out.
That is the number to watch Wednesday night. Write it down.
One more flag, 30 seconds. SpaceX filed for an initial public offering this week targeting a valuation of $1.75 trillion. OpenAI may file this week as well. Two potential trillion-dollar companies trying to go public in the same quarter.
The IPO market thinks this is a great time to go public. Does that match the consumer sentiment data we just talked about? Because those two ideas don't sit comfortably next to each other.
Either the IPO market knows what the consumer data doesn't, or someone is about to be surprised. That's the episode theme, playing out live in the public markets.
Real quick. System update before we close. Wave Trader sitting at $121,437 in equity, 51% cash. Cycle profit and loss improved from negative $10,000 down to negative $2,504. Winners this cycle: Enphase Energy, ticker ENPH, up 10.4%. SolarEdge, ticker SEDG, up 7.3%. Qualcomm up 7.09%. Stops are intact on everything.
Clean week for the clean energy rotation. The numbers held.
TF'd, my system, $111,000 in equity, 45% cash. IMD and Broadcom, ticker AVGO, working. Got a couple of positions that haven't confirmed yet. Watching them, not forcing anything.
3 things to have on your radar Monday. Peace headlines first. If there's any movement on Iran over the weekend, oil tells you immediately whether the de-escalation story holds or falls apart.
Bond market Monday afternoon. If the 30-year starts moving, Warsh is saying something with yields that didn't make it into his press release.
And Marvel Wednesday night. That's the artificial intelligence CapEx vote.
The market can ignore the news for a week, but it can't ignore reality forever. At some point, next week, the week after, those two conversations have to converge. Either the economic data was wrong, or the market was. We're going to find out which one real soon. Trading brothers and sisters. In a week where the market went up and the data went sideways and somehow both were technically correct? Keep your stops tight. Hold your powder on small caps until Warsh shows his hand. And don't let one good headline talk you into a bad trade. We'll see you Monday.